As a binary options trader, you've probably found yourself staring at the charts, curious about those mysterious gaps. What do they mean? Why do they exist? And let's be honest, at some point you've likely thought, can I trade using these gaps? In this video, we're going to dive deeper into the concept of fair value gaps, exploring what they are, their significance, and how you can use them to your advantage. Let's jump right in. Before we continue with the video, I want to invite you to join my VIP binary option signals room for absolutely free. I post 5 signals every day from Monday to Friday with a consistent win rate over 75% and a proven track record. Simply click the link in the description below, which will direct you to my Telegram. Send me a message and I will personally add you to my VIP group. I'm here to help you increase your profits and minimize losses. Try my signals today. You won't regret it. A fair value gap, also referred to as a market imbalance, occurs when there's a disparity between buyers and sellers in the market. FVGs can occur across all market types, including stocks, commodities, crypto, and forex. These imbalances are typically caused by a surge in strong buying or selling pressure, creating an unadjusted area on the chart. This area often acts as a magnet, attracting future price movement as the market seeks to fill or correct the imbalance. Fair value gaps are formed through a 3-candle sequence. They can either be bullish or bearish, and we'll take an in-depth look at each type to thoroughly understand their formation and significance. Let's start with the bullish fair value gaps. A bullish fair value gap is created when there is a clear gap between the high of the first candle and the low of the third candle with no overlap between the two. As illustrated in this example, this gap signifies that buyers hold more dominance than the sellers, often driven by large institutional trades entering or exiting positions. This activity can result in rapid price movements, leaving unfilled orders in the market. A bullish fair value gap often presents a strong buying opportunity as the market tends to retrace to fill the gap. This allows traders to capitalize on the imbalance and enter at favorable levels. Next up, let's take a look at bearish fair value gaps. Unlike bullish fair value gaps, a bearish fair value gap occurs when there is a clear gap between the low of the first candle and the high of the third candle with no overlap between them, as shown in this example. This gap indicates that sellers have greater control than buyers, once again driven by large institutional trades entering or exiting positions. This can lead to sharp price movements, creating unfilled orders in the market. A bearish fair value gap often offers a solid selling opportunity, as the market typically retraces to fill the gap. Traders can take advantage of this imbalance and enter at favorable levels. Now, these imbalances can be found on charts across all time frames, from the 5-second time frame to the daily time frame. Whether you're trading exchange regulated markets or OTC markets, these gaps are constantly forming. So I went ahead and marked several fair value gaps on the 5-minute time frame. You'll notice that the imbalances on the left side of the chart have already been filled, while those on the right still contain unfilled orders waiting to be mitigated. When identifying fair value gaps on a chart, they can be categorized as either mitigated or unmitigated. A mitigated fair value gap is a gap that has been reduced or fully filled, reducing the imbalance by fulfilling some or all of the previous unfilled orders, as demonstrated in this example. Now, an unmitigated fair value gap refers to a gap that has not yet been filled or reduced. It remains prominent on the chart with the imbalance unfilled and its unfulfilled orders still intact, as shown in this example. As mentioned earlier, fair value gaps can act as magnets, serving as potential pullback areas for securing favorable entries. However, relying solely on FEGs may not be a sustainable long-term approach. When trading with fair value gaps, I wouldn't recommend relying on them exclusively. Instead, I strongly suggest incorporating them into a broader strategy or combining them with other confluences. Combining fair value gaps with confluences such as support and resistance levels, indicators, or price action can significantly enhance your trading results. I strongly encourage you guys to find a solid, profitable fair value gap strategy. Don't get me wrong, there are plenty of strategies out there, but if you ask me, I've got the perfect one for you. About 9 months ago, I posted a gold trading strategy specifically designed for binary options. This strategy combines fair value gaps with other indicators and confluences to maximize results. If you're serious about expanding your trading knowledge and most importantly boosting your profits, this is a strategy you need to try. The link to the strategy is in the description below. Go and check it out. And that's a wrap, guys. I hope you gained some valuable insights today and that your curiosity about those mysterious gaps has been satisfied. Now that you've deepened your understanding of fair value gaps, put this knowledge to work, use it to your advantage, and start making some real money. But otherwise, I hope you guys enjoyed the video, and if you did, go ahead and smash a like on the video and subscribe to the channel if you are new. And I will see you in the next one.